Hi guys, welcome to the A Plus Trading channel. Now in today's video we'll be discussing understanding stop loss, take profits and understanding market orders. Without further ado, let's get started. Alright, so in this video we'll be covering understanding stop loss, take profit and market orders. Right, so essentially stop loss and take profit helps us in the risk to reward ratio management. So stop loss tells us how much do we need to risk on this trade, and take profit tells us how much profit do we need to take on this trade. Do I need to risk $100 to make $300? Do I need to risk $50 to make $100? Market orders is where do I want to enter the market? How do I want to enter the market? Do I want to enter when price reaches a specific level, when prices drop to a specific level? So we'll be covering each of these topics in detail in this video. Alright, so what is a stop loss? Now, stop losses are exit orders that you can set to automatically close a position if it reaches a specified price that is worse than the underlying market's current price. Stop loss orders are an essential tool to help minimize your losses if price moves against you. So essentially what a stop loss is a protection or a covering of your money when you're trading. So say for instance I'm saying that I am expecting the euro dollar to rise against US dollars. So I place a buy trade anticipating that the euro will rise. However, the opposite happens and the euro start depreciates against the US dollars. Now, if I have a stop loss in place, this prevents me from losing all my money in my account. So I would say, alright, I'm willing to risk $100 on this trade. So I'd put a stop loss of $100. So once it reaches the $100, I'm closed out of the trade with that $100 loss. So essentially stop loss is a covering that protects your capital from losing to the market. Alright, so an example of this we have right here is you're aiming for 40 pips profit from buying Euro USD, but are worried that the market may reverse. You only want to lose a maximum of 25 pips from your trade. So you set a stop loss at a specific price to automatically close it and limit your losses. So we're buying the Euro USD and we're anticipating a profit of 40 pips. So we're anticipating it's going to move 40 price movements in our direction. However, the opposite happens. So what we did was put a stop loss in place of 25 pips. So if the market moved 25 pips against my position, then I would have been out of the trade with a specified loss. Alright, so that's essentially what the stop loss does. It protects your capital from being blown to the market, and I think every trader that is trading definitely needs to have a stop loss in place, because you're not going to be right 100% of the time, and as such this is where the stop loss placement is very important. Alright, so essentially stop loss is how much do you want to lose on a trade. If my analysis is wrong, if my prediction is wrong, what's going to happen? How much am I willing to lose? Alright, so that is essentially what a stop loss is. Now we're going to touch on take profit, and take profit is the opposite of a stop loss. Now what is take profit? Take profit orders are exit orders that you can set to automatically close a position if it reaches a specified price that is better than the underlying market's current price. They can help you to be disciplined with your trading strategy and not chase profits unnecessarily. Alright, so this is essentially how much do I want to make on a trade, right? Am I aiming to make $100 off this trade? Am I aiming to make $200 off this trade? So that's essentially what the take profit is. You set a take profit for the trade that when price reach a specified price, I'm going to make this specific amount of money on this trade. So I'm not able to make more than what I have set out to be my take profit, because as the market automatically reaches that price, it's going to close me out with that profit. Alright, so that is essentially what a take profit is, and we're going to touch on an example right here. So you buy the GBP versus USD at 1.3260. You're planning on closing your trade if it hits 1.3300, earning you 40 pips of profit. By setting a take profit at 1.3300, you're leaving an order to automatically close in the position there. So in this example, the trader is aiming to profit of 40 moves upward from 1.3260. So when this 40 pip movement has been made, the trader's position will automatically close with this 40 pip position, and now that money is in the trader's account. Alright, so that's essentially what a take profit is, and the take profit and stop loss works together to fulfill the trader's aim. The importance of having a stop loss and a take profit: you're basically profiting off more than what you're risking. So it's essential that each trade you're taking, you need to ensure that I'm aiming for higher profits than my stop loss. It doesn't make sense that you have a stop loss of say $50 and you have a take profit of $40. That means that if price should hit your take profit, you would only make $40. But if price should hit your stop loss, you would lose $50, losing more than what you would have gained from a trade. Essentially, you want to have your take profit at least 1 times or 2 times your stop loss, so you're earning 2 times on what you would lose if you should lose a trade. Now we're going to touch on market orders. All right, a market order is an instruction by an investor or to a broker to buy or sell a stock, shares, bonds, or other assets at the best available price in the current financial market. The market order tells the broker, when should I buy at this currency pair, when should I sell at this currency pair. All right, and we have different types of market orders. So we have a market execution, we have a buy limit, we have a sell limit, we have a buy stop, sell stop, buy stop limit, and a sell stop limit, and we'll be covering each of these market orders. All right, what is market execution? Now, market execution is the method by which traders execute orders at the current price within fractions of a second. So market execution is essentially you placing a trade at what the current price of the currency pair is at this moment in time. So if I go to the market and I see a ask price or a bid price, I'm either buying or selling at that specific price that I'm seeing. Now, what is a buy limit? Now, buy limit order is an order to purchase a currency pair at or below a specified price, allowing traders to control how much they pay. Alright, so here is a depiction showing what a buy limit is here. So essentially the market is trading at this current price here. Let's say I anticipate that price will drop first, then go up. What I would do is that I would place a buy limit here at a specific price. So when price reaches here, I would automatically enter into a buy trade to the upside. So here's an example. So let's say you want to buy the Euro USD and the current market price is 1.3214, but you believe the price will drop down to 1.3213. So you place an order of 0.1 lot at a limit price of 1.3213. A few days later, the price drops below the 1.3213, which means you would enter the trade. What this example is telling us about the buy limit is that if price drops below a specific price, automatically I would enter the trade for a buy. Automatically I would be in a buy for the Euro USD once price drops below the 1.3213 level. Alright, so if you're a trader trading the market and you're anticipating the future moves of the market, saying that, alright, even though it is trading at this price, I'm anticipating that it's going to drop for a bit and then go up. So to enter at a better price, I set a buy limit. So once it reaches that specific price that I anticipate that pullback to be, then automatically I'm in a buy for the trade. This has a bit of downside because just imagine you set a buy limit for price to pull back to a specific level, however it keeps dropping in your opposite direction. So you have to be careful when doing your analysis, and you're not going to be right 100%. As such, I touch on the key importance of having a stop loss with each trade that you're taking. So say for instance you are wrong about this buy limit and price keeps dropping below 1.3213 and keeps dropping and dropping and dropping and not going up back. Now, if you had a stop loss in place, it would prevent you from losing any more than what you would have risked for this trade. it would basically tell you that your analysis is wrong and I'm willing to take a loss right here. So the next one that we're going to touch on is the sell limit, and the sell limit is basically the opposite of a buy limit. So a limit sell order is an instruction to sell the currency pair at the market price once the market reaches your specified price or higher. So right here we have a picture showing what a sell limit is. So say for instance the market is trading right here at this current price. What I'm anticipating is that price will rise first and then drop. So with that being said, I set a sell limit at this specific price. So when price rises, I automatically enter a sell at this level. And if price starts trading to the downside, then I'm at a good entry point. And we're going to touch on an example right here. So for example, imagine Euro USD is trading at a price of 1.3225 and you want to sell if the price gets to 1.3229. A limit order can be set at 1.3229, which will be filled only at that price or better. Essentially, the market is trending down, but I'm anticipating that it's going to pull back up further before it drops. So what I do is set a sell limit at the 1.3229 level. Once price hits that level, and then I will automatically enter a sell trade to the downside. Alright, and it's also important that you have a stop loss, because what if you anticipate it to just go up, then start trading down and it continues going up? So a stop loss would also protect you in this case to say, hey, my analysis is wrong and I'm willing to take a loss at this specified price. Alright, the next one that we're touching on is the buy stop. Now, what is a buy stop? A buy stop order instructs to a broker to purchase a security when it reaches a pre-specified price. Once the price hits that level, the buy stop becomes a market order fillable at the next available price. Alright, and here we have a picture showing what a buy stop is. So essentially what we're saying is that I'm anticipating that the market is going to go up, so I set a buy stop at a specific price. So once it breaks that specific price, automatically I'm in the trade. You're saying to yourself that, alright, I know the market is rising and I think it's going to keep rising. So I'm going to set a buy stop higher than the current market price. So once it reaches that market price, I'm automatically entered into the trade at a buy position. So if it keeps continuing, then the trade will go good for you. So an example of a buy stop. Now, for example, say you want to buy GBP USD, which is currently trading at 1.2903, but you believe that the price will break above that threshold. You can place a buy stop order by setting a limit on the price of 1.2905. As soon as price reaches your preset limit, the order turns into a market order and is processed. So in this example, essentially, as soon as price hits that 1.2905 limit that we had set out, automatically I'm entering into the trade at a buy. So I set a price higher than what the current market price is trading at, anticipating that it's going to keep rising, and once it does that, then I'm automatically in the trade for a buy. And still, it's always important to have a stop loss and a take profit with all of these. So essentially, what if it breaks 1.2905 and starts trending down back, then I'll be in a losing trade as the trade is going against my position. So then I might say, alright, I'm wrong about my analysis and I will cut my losses once it moves 25 pips against me. And it's essential to have a take profit too, because if it breaks 1.2905 and keeps trending up, I need to know how much profit am I going to take on a trade. I have to be realistic about this, because price is not going to just keep rising. I need to say, alright, once price moves 40 pips above this level, I'm willing to take profits and I'm out of the trade. So the next one that we're going to touch on is this. A sell stop limit is a conditional order to a broker to sell the currency pair when its price falls up to a specific price. And here we have a picture depicting a sell stop right here. So essentially what a sell stop is telling to us is that, alright, I assume that the market is going to drop below a specific price. So what I'm going to do, so here's the current market price of the market. I am assuming that the market is going to drop below this price point here. So I set a sell stop. So as soon as price breaks this level, I'm automatically in this trade for a sell position. All right, so that's essentially what a sell stop is, and we're going to show an example right here. So say for example, say you want to sell GBP USD, which is currently trading at 1.2903, but you believe that the price will break below that threshold. You can place a sell stop order by setting a limit on the price of 1.290. So as soon as the price reaches your preset limit, the order turns into a market order and is processed. Alright, so I'm anticipating that the market is going to keep dropping. So what I do is that I set a sell stop at 1.2901. So as soon as it breaks that level, I'm automatically in this for a sell position. And I still stress the point of having a stop loss and a take profit in each of these scenarios, because what if price was to break that 1.290? Your sell stop has been triggered and you're in it for a sell. However, price starts moving back up to 1.2903 against you. So you need to know when to cut your losses. Alright, will I cut when it's 20 pips against me? Will I cut when it's 50 pips against me? Etc. And if it keeps dropping, I need to know how much profits will I take as well. Now we're going to touch on what is a buy stop limit. A buy stop limit is when you predict a temporary fall in price followed by an upswing. It's a combination of a buy stop and a buy limit. So essentially what this is that, alright, I'm anticipating that price is going to go up, then fall, then continue up. So what I would do is that I will set a buy stop at a specific price. Once it breaks that specific price going up, instead of a buy stop where it turns automatically into a market order where you are into a buy position, it triggers a buy limit below that specified price. So once it pulls back to that price, then I'm automatically in for a buy limit. Alright, this one is a bit more complicated. So what I'm going to do right here is that I'm going to do a drawing of this one to explain this one. Alright, so say for instance the market is trending up right here. So we have a market that is making a series of higher highs, higher lows. We're in an uptrend. Alright, but I want to enter not at these top, but when the market is being pulled back. What essentially I do here is that I would set a buy stop limit somewhere about here, right? Drawing is not good, but we set a buy stop limit right here. So when price taps into this level, then automatically I'm in the trade. I know the market moves in a direction like this, knows it make higher highs and higher lows in an uptrend, but I want to trade when the market is pulled back. I don't want to catch these highs right here. Alright, so I would go like this. Alright, I would set a buy stop right here and a buy limit right here. Now remember, a buy stop limit is a combination of a buy stop and a buy limit. What is a buy stop? A buy stop is when price is continuously going up and you set a price higher than the current market price. So once price breaks that, you're automatically entered into a buy order. Now, with the buy stop limit, once you say for instance the market is trading at this price, I anticipate that the market is going to go up first, then pull back, then continue upwards. What I would do is that I will set a buy stop. So once price reaches that, instead of me going into a buy order once it is triggered, it then triggers what we call a buy limit instead. And a buy limit is when you set a price below the current market price. So once price reaches that level, then you're triggered into the position at a buy. So once the buy stop is triggered, then it triggers a buy limit at this price. So if market should pull back to this, then I'm automatically entered at a buy right here. Alright, so that's essentially what a buy stop limit is. I'm going to do it once more so that you guys can understand it, because I know this is a bit tedious. Alright, here again, the market is here. This is our current market price. Alright, let me use a different one. So this is our current market price right here. Alright, I'm anticipating that the market is going up first, pulling back and then continuing to the upside. However, I don't want to be in the pullback. I don't want to enter here and then the market pulls back. I want to enter directly at the pullback. So what I do is that, boom, I set a buy stop right here. So once price reaches here and breaks this price point right here, then a buy limit is triggered at the specific price that I want, and then I can enter the trade at a better entry. So let's say this price right here is 5 and I put one here for 3. Alright, so I put a buy stop of 5. So once price breaks the 5 level, I'm automatically entered into the trade. But instead of a market order, I'm entered into a buy limit. So even if price continues up and never pulls back to the 3 level, then I would not be in the trade, because once the buy stop is triggered, it triggers a buy limit. So market has to pull back into the buy limit zone for me to enter into the buy. Otherwise, there is no trade. So if I put the buy stop at the 5 level and it keeps rising to 6, 7, it continuously goes up. Say for instance, it does something like this, and this continues going up, and my buy limit probably is here at 3. Right, my buy stop was at 5. It triggered the buy stop, however it never did a pullback to the 3 level so that I could enter into the trade. It keeps continuing up, then I would not be in this trade. Alright, so that's essentially what a buy stop limit is, and we're going to touch on a sell stop limit, which is basically the opposite of this. Alright, now what is a sell stop limit? A sell stop limit is when you predict a temporary rise in price followed by a downswing. So it's a combination of a sell stop and a sell limit. Alright, so what you're anticipating is that the market is in a downtrend. We're anticipating that it's going to pull back first, then drops below. I'm going to show you an example in the form of a drawing on this one as well. So the market is trending down. Alright, we're forming lower highs and lower lows. Market is trending down. Alright, however, I don't want to sell here and the market pulls back to here. Let me use a different color. I don't want to sell here and the market pulls back to here. So I want to enter at these lower highs. I don't want to enter at the lower lows. So essentially, say the market is trading at this price right here. What I would do is that I would probably set a sell stop right here at this price. Say this price is 5. Alright, and this price here is 7. Alright, I would set a sell stop right here. So once price reaches this level, the sell stop would be triggered. But instead of a regular sell stop where it turns into a market order, a sell limit is triggered once it reaches the sell stop level. Alright, and the sell limit level is below the current market price. So price would have to pull back to my sell limit level of 7 right here. Once it does that, then I'm automatically entered into the trade. And same like our buy stop, if it does not pull back to that level, then we're not in the trade. So say for example, the market just keeps dropping in a straight line, just going down, but not giving us that heavy pullback, and I set a sell stop here at 5. Once price reaches this level, the sell stop would be triggered. However, if it doesn't pull back to my level, I would not be in the trade. If it keeps continuously down, then I would not be in the trade. So with a sell stop limit, you're basically trading the pullback of a downtrend. You guys have to find out which of these entry points is best for me. Do I like to take a market execution? Would I like to take a buy limit, a sell limit, etc., etc.? So it's essential to know which one of these you would like to trade with when you're navigating the Forex market, the stock market, the futures market, any market that you're trading in. It's essential to know which one is best for you and based on your trading style. Alright guys, so I know this might be a bit tedious, right, but you can continuously watching over the video to master this skill point, master this entry point, master a buy stop limit and a sell stop limit, and know which one of these market orders would you be more interested in using when you are currently trading the financial markets, whether it be stocks, currency pairs, etc. You can use all of these market orders to execute your trade effectively and get the best entry point that you possibly could get. Alright, so this brings us to the end of our video covering stop loss, take profit, and the different types of market orders. Hope you guys have learned something from this, and definitely watch out for more videos coming on topics related to Forex and mastering the financial markets. Alright, and remember, trading can be the next big thing for you. Do not give up on the journey.